Sam was also hedging with the SPY puts, which brings us to Jim's question. Sam had just mentioned that he's holding 339 puts on SPY right now because he fears or feels that the outbreak and numbers that we're going to start seeing for the coronavirus are not over, and also probably maybe the effect long-term on the market has yet to be realized as well. So Sam mentions he's 339, I believe you said, Sam. 339 puts on SPY right now as a market hedge. And Jim says, is now a good time to buy VIX calls if they're below 14? I'm not really sure. I don't have any VIX calls right now, Jim. I sold mine out for a profit on the last spike, and then the following spike after that. I don't think I've had any VIX calls for about a week and a half to 10 days because the price was too much. A week ago or 2 weeks ago, we talked about the concept of maybe doing bear call credit spreads as you feel the VIX is going to settle down off of a peak. But I mentioned I was scared of that for the same reason that Sam just mentioned, that I don't know if we're through the woods on certain ideas, concepts, and other things. So at 19, a VIX bear call spread done 10 days ago, about what I mentioned when I haven't traded them since then, looks like it would have been a really good idea. The unfortunate risk is the fact that if some news comes out over the weekend, we don't see it till Tuesday, and the VIX opens up at 20, that bear call spread might be highly threatened in that case. So is it a good time now to buy the VIX calls? I'm hesitant to say that. My usual target is below 12 that we hit here. That's what I think I bought the last time. Got some profits here. Yeah, and I did buy again here at 12.50, I think was this time. Got out of half here, got out of the other half here. Not at the big point. I missed that big point, but I got out of half here. So I haven't been in anything since here. I haven't been in any VIX calls since here in that case. So I don't want to nitpick, but let's put it to you this way. You could still get some decent calls on the VIX as a market hedge going maybe 40, 45 days out in time. And what you would do, of course, is maybe look for a call option. This is part of what I do, is look for a call option that's maybe priced around $1 and maybe buy whatever, that represents maybe 2-3% of your total portfolio, 8 contracts, so forth as well. As you can tell by the way the chart's looking, it's kind of tricky to do it this way, but if you look at the chart, yeah, it's still descending, and we're below the SMA 20. It looks bearish. Sam offers that VEX and VEX, excuse me, I think he meant VIX, or maybe he meant VXX, but in any case, UVXY and other volatilities still look bearish. VXX, they still look bearish. And I'd agree. If I looked at this chart without knowing what it was, I'd say, yeah, this looks like a bearish decline. It looks like it's still going down. MACD's pointing down. But unfortunately, we can't really base the volatilities on that. I mean, we can if the market stays strong, but this is, when we see this, it's because of something that was unexpected. Again, something could come out over the weekend. Other things could double as well. Okay, and so that would be an issue where we could just wake up on Tuesday when the market opens, we could be at 20, 21, 22. So Jim, I'm kind of in an agreement with Sam right now. Might regret, to be honest with you, I might regret, or I could have regretted any time over the past 10 days not having a hedge in the VIX in case there was one of those sudden unexpected spikes. But I didn't like the prices where the strike prices were in this case. If I were, and I'm not, I'm kind of with Sam on this. I'm not buying yet, waiting for lower. But what I would consider doing, of course, is if I went to the option chain for just calls on the VIX, if I was going to open something this week or maybe Tuesday, I'd probably go out to March. Oh, I really don't like it. Let's go to the large chain. And this is just for me to keep the math simple. I'd have to be targeting probably the 18 strike. Or I might go to the 19. What I'm looking for is to pay around $1, $1.20, maybe buying 8 contracts at $1, $800, $900, somewhere in that range, maybe 1,000 if it's at 120 with 6 or 7 contracts, for example. And also, who was it? Jim, was it you and I that discussed last week? I don't remember. But we got into this discussion where I got into a discussion with a customer where, in general, you might want to look for a delta of 0.3 with a price of $1. And it does look like the 19 is probably the closest one to those two factors. But again, I'm not buying right now. Last time I bought, when it was at 12.50 and 12, I bought the 16 strikes. Okay, so that's when I got those. I got the 16 strikes, and I'm worried that, why am I worried about saying the 18 and 19 are too high if they have the price I want and the delta I want? Because remember, the last jump that we had only went up to 19. It didn't go beyond that. It went beyond that very quickly at the beginning of the morning, but then it didn't continue. Now, this would gain in value, obviously, in that case, but I'd rather be in the 16s when it spikes up to 18 or 19 or 20 rather than being in the 19s if it goes up to 18 or 19 for the same price. So half a dozen of one of the other. Flip a coin there in that case, okay? But to answer your question, if you have fear, Jim, you have concerns that something could go wrong, then to ease your mind, I'd say yes. Right now, buy puts on SPY, look to buy calls on the VIX, shares of UVXY, that other volatility ETF that Sam trades for using it as a market hedge. And the great thing about doing that is that it's easy to sell premium against it on portions of those shares. You know, if you have 300, 400 shares of an ETF, like UVXY or VXX even, you can sell calls against it during the lull as a covered call position, or sell 2 calls against it so the other 200 shares are still open in the case of a large event to lower down the cost basis, and you're still actively trading as an options investor. Oh yeah, and I'll go back to that chart just one moment. There you go. Yeah, you can see what Sam says is last time VXX lost its gain in 2 days. So did the VIX. There was its peak. 2 days later, you're right back to 16. When you see it, that's why I got out here. That's why I didn't wait. When you see the peak, you've got to typically get out as fast as possible. Don't try to play it, say, oh, it could go to 21, 22, 24, 25. You've got to play the spikes or you risk losing it. And then in this case, you got it back again 2 days later, but normally you get the spike and then it's gone. 2 days later. Get a spike, gone 3 days later. Okay? It's very tricky. I did. And Sam says you should sell half the first. You sold half the first day. Oh, you're saying I did sell half the first day. You're absolutely right. But I just wanted to illustrate it in this case of why I do it on the first peak. I don't wait for that second one, if there even is a second one, because 2 days later, just as you know, Sam, 2 days later it's gone. VXX, UVXY would look extraordinarily similar. You get a spike, a couple days later it's gone. Okay, you get a spike, a couple days later it's gone. Oh, there's another double spike, but 2 days later, 3 days later, it's completely gone. So you got to take them when you see the spike right away. Or what we talked about with managing the long calls, same thing in this situation, sell half. That's when I sold half, sold the other half. Got out of them, haven't bought new ones yet. Don't think I'm going to buy anytime soon. Okay? All right. Fernando adds, oh, okay. So this is just a thought on what I had mentioned on the VIX calls and the targets there. Fernando has a different thought here that he likes to use. He says, to play the bearish side of the market, I prefer to buy a put, 0.4 delta on single stocks and manage. And that's just a fine approach as well. And in that case, and what I mean by that, what I'm using the VIX calls for is only to hedge a portion of my portfolio. That portion of my portfolio, 15% of my trading capital, is allocated to bull put spreads, and I've got another 10 or 15% I'm using for some diagonal spreads on higher price stocks like Amazon that comes up here in Google. I'm not in either one of those right now. I just, that's how I trade the higher price stocks. I do them as diagonal spreads. Some people call them the poor man's covered call, and you've heard me talk about why I don't prefer to use that phrase. But as Fernando was mentioning, he owns stock, of course, and he's buying, structuring at the 0.4 delta. Well, 50% of my portfolio is in the married put positions following the radioactive trading techniques, where every stock position I own is protected by that far out put that Terry mentioned at the beginning of the presentation. So none of these positions can lose more than 4 or 5%, even if the market drops 10, 15, or 20%. That's the most I can lose in that situation. Okay. And so that's what, there's nothing wrong, of course, with what you're talking about with these single stock delta structures on the puts there, Fernando. You know how I do it the same way also with the married put structure in this case. But that's, I don't even worry about hedging this. Those VIX calls are to hedge the bull put credit spread and calendar spread portion of my portfolio for the unexpected event. What a bull put that's actually at maybe even a 30 or 40% gain before expiration. In the sudden event, we go back to it. I had 3 positions during February 5th through 9th of 2018. Remember that large volatility spike? I think it was the first round of tariffs, if I'm not mistaken, or the discussion of the Chinese trade war, the first mention of it. And I can't remember exactly what it was, but in any case, I had a 3 bull put credit spreads open: Netflix, Texas Instruments, and I always forget the third one. The day before February 5th, I just opened them on January 29th. They were for the 9th or 10th expiration, whatever that Friday was in that first week of February. And on February 5th, the first day of the decline, that large gap down in price, Netflix was at a 25 or 30% loss, Texas Instrument was at a 65% loss, and the other one was at a 62% loss. The day before, they were all at about a 20 to 30% profit. They were still about 8, 9% out of the money with 7, 8 days to go to expiration. One day later, they're at an average of 49.8% loss on the 3 positions. So that's the VIX calls that I had on at that time. Had a profit of about $8,000, which actually more than hedged the loss I took on the bull put credit spreads. But if it covered the bull put credit spreads, that meant the 2 or 3 calendar spreads I had opened at the time were taking about a 60% loss as well, because that's what happens in those events with the leverage positions. So that's all I'm using to hedge that for, is just those portions of my portfolio and positions that can realize an 80, 90, 100% loss in the unexpected event. Long calls, diagonal calendar spreads, credit spreads, debit spreads. You know you can lose 100%. You say, well, I'm far enough out of the money that my bull put can't lose. My bull call debit spread is a 1-to-1 risk-reward ratio, so I'm okay if I lose 100%, and so on. Then that event happens, and you realize how much it just sets you back from the previous winners that you've had in that strategy and that portion of your portfolio. So that's why I use the VIX hedge as well.